Good day and welcome to the Quess Corp Q4FY20 results conference call hosted by Axis Capital Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Aditya Bakul from Axis Capital Limited. Thank you and over to you, sir.
Thank you, Aisha. Good afternoon, everyone. On behalf of Axis Capital, a very warm welcome to the Q4FY20 earnings call of Quess Corp. The management is represented by Mr. Ajit Isaac, MD and Chairman, Mr. Suraj Moraje, ED and CEO, and Mr. Ramakrishnan Subramanian, CFO. So I shall hand over the floor to Mr. Ramakrishnan for the management's opening remarks, post which we will open the floor for Q&A. Thank you and over to you, sir.
Thank you, Aditya. Good afternoon, everyone, and thank you for joining our earnings call today. Please note that the results and the presentation have already been uploaded on our website. Anything we say which refers to our outlook for the future is a forward-looking statement and that we must read it in conjunction with the risks that the company faces. These uncertainties and risks are included, but not limited to what we have already mentioned in the prospectus filed with SEBI. With that said, I will now turn over the call to our Chairman and Managing Director, Mr. Ajit Isaac. Over to you, Ajit.
Thank you. Good afternoon and thank you all for joining this call in spite of the difficult situation that we are all part of. My colleague Suraj, our CEO, Ramki, our CFO, Guru, our Head of India Operations, and Lohit Bhatia, our President of our Workforce Management Team, are here with me for this call. Sitting here in Bangalore, I know that we are particularly lucky compared to many other parts of the country. To all of you who are in Mumbai and on this call, despite the tough external situation, you have our respect and admiration. After being in the employment and jobs business for about 30 years, I realized that this is a one-in-a-generation moment and not everything can be planned for. However, there are some things that we must do as a management team, some things that we can do, and there are some things that we can do and hope for the best. At Quess, we've taken a number of decisions in the last few weeks to mitigate the situation caused by COVID-19, and we are hopeful that we'll come out of this experience as a stronger company. Over the call today, we would like to present the actions we've taken, its impact at Quess, and what we see coming up. Largely, the narrative has been in 3 parts. The growth in our operations of the company and its P&L, where we've done remarkably well to grow revenues by about 30% the last year and EBITDA by about 42%. Second, focus on our cash flows, where our OCF has gone up by 16% and DSO has improved by 7 days from 69. And attention to the balance sheet, where we've addressed some of the risks that COVID represents and where we wanted to be prudent in valuing our assets to reflect possible market conditions. As a result of this, we have had some one-time non-cash impact items. The most significant issue at Quess is how the business model has helped us to stay resilient and how our management team has worked extraordinarily hard in the last 2 months to ensure that we come out of this as a much stronger company. I'm happy to note that there's a refreshing newness to the way we address issues, and this has reflected in the decisions that we've taken to meet the challenges of COVID-19. I would now like to turn it over to my colleague and CEO, Suraj Moraje, who has done a terrific job in his first few months at Quess. Incidentally, yesterday was the first day he attended office after being a CEO for more than 45 days. He will now give you an overview of what we've done and the steps that we've taken to meet with the challenge and the larger plans for the company in terms of how we are charting the future. Suraj.
Thank you very much, Ajit. Good afternoon, everyone, and thank you for being here on what is my first call officially as a CEO, and I hope the first of many to come. I want to start off by saying that I hope you and your loved ones have been well over the past month. As Ajit said, for those who are in Mumbai, our thoughts are with you. I'm a son-in-law of the city, and having spent many years there, I'm confident that this too will pass and the Mumbai spirit will prevail in the end. But I know these are tough times. Let me start by saying that Quess delivered a very strong FY20. The headcount was up 21%, the revenue up 29%, and the EBITDA up 42%. The company's focus on OCF generation saw us grow OCF by about 34% on a normalized basis. And we're especially pleased by the growth of general staffing and all-tech businesses. And I'm sure you've seen some of those results. It was clear to us by the end of Q4, and it's difficult to believe that it was just a couple of weeks after our March 5 Investor Day, but it was clear that COVID was becoming a pandemic. We saw the impact first in Singapore, then the Philippines. And as a company, we moved quite early actually to take some very resolute steps to dealing with this situation. And as Ajit said, to ensure we emerge from the crisis even stronger as an institution. If anything, I think COVID has given us even more execution focus against the winning together priorities that we articulated on March 5, including growing our OCF by 20% year on year and achieving an ROE of 20%. And I'll talk a bit more about that subsequently, but given that I guess the most recent months are likely to be top of mind for each of you, let me first cover the actions we've taken over the last 2 months since the beginning of the COVID pandemic in India and lay out where we stand today. Our first reaction, I think, when we realized it was mostly around probably March 20, that COVID was becoming a big issue in India, was actually to first secure our employees and our associates and put in place BCPs. We were lucky to learn from our presence in Singapore. We immediately moved to adopt protective SOPs. In many cases, our customers actually asked us to help them with keeping their employees safe, procuring sanitizers, sensors. Even in some cases, Magna helped our customers move their desktops home so they could keep working. And we moved ahead of industry to work from home. So we were extraordinarily well prepared to process salaries and close invoices because we moved to work from home even before the Janta curfew. At this point today, I'm happy to say that all of our associates, core employees, have access to telemedicine and emergency helpline. And as we restart with our customers, we've actually built the capability to have each and every one of our employees, associates, log in his or her health digitally every day before leaving for the office. And we do track it as best as we can. In addition to securing our employees, we focus on 3 things. And we formed 3 task forces very early on towards the 4th week of May. 1 task force around customers, 1 task force around cost, and 1 task force around cash. Let me talk about each of these in theory. I'll talk about customers first. Our customers have been a pillar of our strength in these times, and we've been blessed. We've been blessed that we have a third of India's Fortune 500 companies amongst our customers, with the best brand names across sectors. And our downside has fortunately been somewhat protected by our limited exposure to tourism, entertainment, airlines, hospitality. We're lucky to have had no exposure to SMEs. We don't have gig or daily workers on our payroll. Also, we observed that coming into COVID, most of our associates on our rolls were actually not on seasonal peak demand. They were mostly on perpetually outsourced and frontline tasks, which at least so far our experiences have been less effective than some other tasks and activities. So CMI data today tells us that about 120 out of India's 250 million workers in the non-farming sector lost their jobs through April. That's almost 50% of the total stock. I'm sure all of you are expecting that as India's largest employers, we would be impacted, and we are. I am blessed today to report to you that the impact to date on us has been far less than feared. Our employee count through April was around 5% down from our February number at 365,000 employees. The future is very hard to predict, and we don't want to put bets, but at this moment, our line of sight is maybe similar decline in the month of May and in the month of June. I want to emphasize at this point that each business is working especially hard to make sure we gain in market share through the recovery. We believe that crises are times when market leaders will consolidate even more. We believe formalization is going to set in even more with the coming in of the new labor laws. We believe customers are seeing the difference between the adults and the children and service providers, and the gulf is growing bigger. Each business has defined post-COVID service lines with technology embedded in them, defined target verticals, target customers. We've got new collateral that we're pushing very aggressively through traditional and LinkedIn-based channels. We're driving new client outreach very aggressively right now and monitoring it closely. In April and May so far, we've onboarded 38 new logos in workforce management, more than 12 marquee customers in operating asset management, and 3 new customers in global technology services. Wherever possible, we are also transitioning. Again, we feel blessed to say that we have transitioned facilities management and security services for the Golden Temple in Amritsar. And we've used the downtime to train employees. So far, we've conducted about 35,000 training sessions across our group. So that's the summary on what's happened on the customer side, 5% down in headcount through April, with similar line of sight for May and June. I'll come to cost. We've been surgical with our costs. Our indirect costs in April were about 20% lower than the baseline of our 65 crore per month just 2 months earlier. I want to put this into perspective. The savings we achieved from February to April have been the same order of magnitude as the monthly EBITDA delivered by our largest business, general staffing. We're working to ensure this translates into a structural reduction in cost base of at least 60 crores per annum. The measures we've taken include already we've served termination notices to 15 of the 58 buildings we currently occupy across the country. We're automating large swaths of our compliance management. We're renegotiating travel expenses and changing policies so that everyone, including Ajit and myself, use 999 rupee rooms when we travel. We're switching to e-invoicing as a default for all customers, which will save about 40 lakhs of courier services every quarter. We've been very detailed and very meticulous in tracking what costs we believe we can save. And for us, as much as the cost saving, we believe these actions will build back our muscle as a low-cost organization. It takes us back to our knitting and where we need to be. And I want to reassure you that we've also made contingency plans to say, should we have a sustained economic downturn, should our FTE numbers fall below what we're expecting, we will variabilize further direct indirect costs, and we will watch our numbers very carefully. So that was my update on cost. I spoke about customers, I spoke about cost. Let me now come to cash. Cash is the currency of the moment. I want to assure you that the company's cash position remains comfortable. I'll start off by just saying that we're blessed to be and the third time I'm using blessed, I know, but to be in the business services industry. This is an industry which globally is known to be counter-cyclical in cash generation. Because as we reduce FTE, if we reduce FTE, what actually happens is the working capital that we lock in associate salaries comes down and we release cash back to the company. And you've seen the last couple of months, many of our peers in North America and Europe have actually gone on buyback sprees, utilizing the cash that's come back and been unlocked from working capital. So that's the context of the industry we're in. Again, because of the quality of our customers, March collections were on track, which enabled us to pay salaries to our associates earlier than normal. And that's the reason why we've reported a normalized OCF, which Ramki will come to. April collections have been a bit different from March, given some inconveniences our customers faced during the lockdown, but the spillovers have mostly been collected. We expect no defaults. We're working extra hard to bring down receivables. We've launched task forces against government receivables, non-government receivables. And as I will explain in a bit, we're also adjusting our portfolio and specific business strategies to reduce our exposure to low OCF businesses, as we promised on March 5. Overall, our interest levels remain serviceable. DSO is under control, and Ramki will talk more about that when I hand over to him. Now, having said this, some businesses have been more impacted than others. And I'd like to maybe give you a flavor of what impact COVID has had on our key businesses today. So let me start with the workforce management business and general staffing. Overall, associate headcount in April was also down about 5% from the pre-COVID business. And about half of this actually just came from attrition on pre-COVID period resignation. We do expect a similar decline in May, and we're hoping the impact on June is too early to say. On the one hand, we think that slowing parts in some customers could result in a further slide. On the other hand, we are hoping that the unlocking of the economy, replacement hiring for migrant workers will give us a boost in new mandates, especially the 38 new customers we've onboarded. And what we're seeing also is in many of our customers, while some pockets of skill demands are coming down, other pockets are going up within the same customer. And so we're hoping there'll be some offsets, but we don't want to make forward-looking commitments at this point. I also want to say that there's been a decline in associate incentive payouts in April during the lockdown. which is mostly pass-through for us, but that does impact our top line. It should bounce back as economic activities rebound. In the short term, we also anticipate some pressure from customers due to change maybe contractual conditions, given the own pressures that they're facing. But to date, this has been manageable and largely done in ways which are reciprocal and only for our large, loyal customers, and so it's been largely under control. Moving beyond general staffing, IT staffing is largely on plan. We're seeing some softness and deferrals in new hiring, especially in lower and BPO segments, but I would say largely on plan. Comptel in the Middle East. Comptel had some early hits in Singapore, but now seems to be again largely on plan. In the Middle East, we're working very closely with the e-commerce companies, and we're seeing a lot of tailwinds from there. I want to spend a minute on Excellence. Excellence revenues fell to zero in April as training centers shut during the lockdown. We're awaiting permission to restart, and this business has a cost base of about 15 crores. We are working to bring that down. We expect that to come down by 10 crores by May. And as I will cover later, we're actually working to re-engineer the OCF profile of this business in this year, and we're hoping for dramatic differences there by reducing our exposure to the government business. Moving on from WFM to OAM, I'll start with facilities management. This business did reach a milestone of sorts by hitting a headcount of 50,000 FTE by end of March. Overall, we're very bullish about our OAM business. We believe this business will greatly benefit in the medium term from the dynamics we're seeing. Companies are paying much more attention to quality of sanitation. They're coming to realize that larger players deliver better. And this accelerated formalization and flight to quality we're seeing will create huge tailwinds for this business. And while we expect some shrinkages from work to home in the medium term, some of our customers are announcing it. We do think that formalization will offset that, and in the long run, we'll see growth in this business. There have been a couple of temporary headwinds in this business. One is the food business in offices and education institutions is down because of lower traffic and closure of education institutions. The second is some margin pressure because our customers are all rationalizing costs and they want to rationalize the site of on-site teams. Again, at this point, these are rounding errors, not something to worry about. And we are doing a lot to compensate this with new service lines. So as of May 30th, we did about 10 million square feet of terifumigation. About 120 new clients came in through terifumigation across hospitals, banks, oil and gas, and eminent education institutions. So we do see some momentum there. I do want to make a remark here, which is we want to see more growth in this business going forward. We are investing in it. We've brought in additional sales capacity, organization capacity to drive this, and this is a priority for us to do. Moving on from facilities to careers, during this pandemic, I think most of you have heard and seen security has become an essential services. All of our sites have been active. There's an increase in demand for the services linked to technology solutions that have minimal physical intervention. We're doing a lot of new bundled service offerings to customers like fever screening, thermal cameras, terifumigation chambers. We've launched Secure, which is our proprietary reception management system, which is integrated to a central command center. And we've got, no puns intended, but we've secured several orders for Secure already. The team is working with clients to provide high service levels and try to be as cost effective in this time while implementing the new COVID-19 norms. All our trainers are certified for preventive and awareness programs linked to Apollo, MedSkills, and WHO. And as I mentioned, we have added several new clients, including a transition to the Golden Temple. This team is strongly focused on operations. We've had a new CEO join us here as well in April, a veteran of the security business, Dr. K. Ramesh. And we'll strengthen our focus on operations and growth even further. We've had our DSO in this business come down from 82 days to 67 days over the year. And we're continuing to build our capacity. The third part of the OAM business that I want to touch upon is industrial. This has been a business which was quite troublesome last year and the year before. I'm happy to say that we think we've bottomed out here in our restructuring. We have seen positive momentum. We strengthened our talent here also. Anil Bhadoria has joined us as the incoming CEO in April. During COVID-19, the business has strengthened its pipeline, including intensifying discussions on maintenance and shutdown services. We've also used this business a little bit to drive our cross-sell, launching our Customer Connect program, which is basically bringing all of Quess's service offerings across facilities, security services, general staffing to our industrial customers. And we're hoping to see good momentum there as more manufacturing facilities open. This business also used COVID time to increase its digital intensity. Our InEdge app is now rolled out to 3,500 employees there for online attendance, communication, and we're taking steps to digitize our workflow and recruitment there. So that was a quick update on OEM. Moving to our global technology services, I would say this has been a mixed bag. Let me start with the North American IT services business. It saw its best revenue quarter ever in Q4. And April, we've seen relative stability except for a small drop in our government revenues in Ottawa due to some work-from-home constraints for security-cleared work, which should start coming back over the coming weeks. So overall, North America is still on business plan. We've observed that, frankly, of all of our geographies, that's where sales activities seem to be continuing as normally. It seems people that are used to working with distance and video. And so we are largely on track. We've had 6 new client introductions in Q4, another 3 in April, and we are poising this business for growth, and we're pushing this business for growth in the coming period. Of course, in the short term, we don't know, but this is how we're thinking about it. In our Allsec business, the HRO business is just very robust. This is about half of the EBITDA in Allsec. Many of you would have probably read the press release from the Allsec annual results. Allsec processed more payrolls than ever in Q4. And so far, the payslip numbers are holding up and giving us a little bit of insight into how good or how bad the employment issue is, because there we're not seeing payrolls drop as dramatically as maybe some numbers might suggest. The call center business in Allsec and Connect have seen very significant disruption. It started on March 15 with the shutdown of Manila, where overnight our ability to deliver work dropped to literally 0%. I'm happy to report that in a couple of weeks, Manila was back up to over 80% of its regular load. We shipped desktops home, but we were also able to book hotel rooms for our employees right next to the call center so they could walk to work. In India, we're working at about 45% work from home by the end of lockdown, and now we're slowly ramping up our operations from the office as regulation permits. And some of our tech enablement investments came to help here. In India, actually, I think our Connect business is probably best in class on enabling work from home agents in voice. However, we will see, EBITDA from this domestic call center business fall significantly until when operations can resume normally. These both Allsec and Connect are in positive EBITDA territory, I would like to emphasize, but it is lower. About 25% of Connect's revenue in the normal time comes from our collection business, and that was a bit of a hit to us in March because the last week of March is usually the best collections week in the whole year. We're hoping that once moratorium is lifted, given the backlogs and emerging factor delinquencies, we will see a big uptick in the collections business. We're gearing up for it and talking to our customers, and let's see how this goes. I just want to touch on Monster quickly. I think Monster has been something we spent a lot of time talking about last year. After sequential reductions in EBITDA losses, we're now at an EBITDA loss of, let's say, between 1 to 2 crores a month at this point. And seeing significant search volume growth through Q4, a little bit like its competitors. Naukri has seen search volumes down by 50% in April versus February. And sales volumes are significantly lower as renewals go down, as recruitment scales back, and people hold back from spending cash. So we will go through some short-term headwinds there. We will keep losses to a manageable level. And our focus now is, the product performance has gone up significantly, and we're using this period to sharpen our value proposition articulation better. I hope many of you have seen our new ads for Monster around the price proposition. And we're training our sales force and our customer retention teams to make sure we come out of the block running when recruitment starts. So that was the update on COVID and how we're trying to make lemonade out of lemons that have come our way. I do want to spend a little bit of time going back to March 5, where we spoke about our Winning Together promise, the objective of hitting a 20% ROE while delivering a sustainable 20% year-on-year growth in OCF. I want to highlight some of the steps that we continue to take and some of the progress we've made also against the things we spoke about on March 5 to you. There were three parts of winning together: winning with customers, winning with people, and winning with investors. Let me start by winning with customers. We've doubled down on our cross-sell efforts. We do well in pockets already. For example, over 80% of our revenues in facilities management and security come from shared customers. 21% of our top 30 clients work with more than one vertical, accounting for 3,500 crores of revenue. We've launched a fresh initiative now around the top 75 named accounts, where we'll focus on adding additional service lines and improving our account management. We will conduct our first national sales conference tomorrow, actually, digitally, to further increase the cross-sell fluency of our frontline. And this is something which is very much in focus. Our push towards digitally enabled revenues is accelerating. Our associate workforce management app is now connected to 235,000 associates. And we're beta testing our internal recruitment platform, which will also help us share talent across our verticals internally at Quess over time. We're seeing also a very interesting increase in cross-vertical managed services projects. For example, just last week, we concluded a deal with a leading bank, wherein Connect, Heptagon, and Quess Staffing are jointly stitching together a service that will help the bank increase its sales productivity. We're excited about this. We think this is the direction that more and more we'll take in the future. And we're happy that it was important enough for the client to even close during this period. We think that the value proposition is strong. Nobody else here can copy this, and we want to do more of this. Our rebranding effort is also gaining momentum with significantly improved CRM and collateralization. I do hope all of you are following us on LinkedIn, for example, and noticing the increased presence of our brands and the increased activity and better articulation of our proposition over the past month. I'll talk about winning with people briefly. With the support of 99% of voting shareholders, we've launched our new RSU scheme. So thank you for all of you who have voted. The initial grants cover about 60 plus of our top employees, and we really see this. It's come as a shot in the arm for many people who, many of them have taken pay cuts. Many of them have gone out of their way to really over-deliver at this time. And I think it's come as a shot in the arm to understand that we're taking a long-term view to the business. The vesting here is very much linked to our 20% ROE and OCF growth targets, and people are understanding. So the alignment has gone up. We're also strengthening our team, and we're continuing to strengthen our team with top talent, both to increase our technology intensity and to drive key businesses forward. So Shekhar Garissa has joined us from Microsoft as the Chief of Corporate Development and Emerging Businesses. Joy Kurian joined us from Accenture as the Chief Technology Officer in Q4. Rupal Sinha joined us to lead Golden Star and healthcare vertical. She's had over 20 years in the industry across security, facilities management, and we're very pleased to have her on board. I mentioned Dr. K. Ramesh, who joined us from G4S, and Anil Bhadoria, a long-term veteran in the industry, who joined us to lead our industrial. Let me end with maybe the most important for this call, which is how we're winning with our investors. I just want to give you a few short updates. We will conclude the termination of our partnership with QEBFC as of end May, and we will make sure there are no further liabilities in that front. We did announce that we were looking to dispose of Defendo. Unfortunately, the discussions were delayed due to COVID, but fortunately, COVID has actually seen us have increased interest in the assets. We are hopeful that we will find a good outcome for this asset. In the meantime, we are keeping the burn here to less than 50 lakhs per month. As discussed on March 5, we will continue to take action to adjust our portfolio where we don't see a favorable OCF generation or ROE profile over time. We have taken two decisions since our last discussion in March. One, we have restructured our selection and executive search business. This has been a relatively small part of our revenue, but it historically had low margins and a troublesome collection cycle. So we've shut down some of the less profitable service lines, merged the less with Magna, which will allow us to capture cost sales synergies while giving us a better EBITDA and OCF profile. The second decision we've taken is on Excellence. Excellence has been one of the government's largest partners in their programs across DDU, DKY, and PMKK. And we are one of the country's few champion employers. And we've been working with the government to improve the cash flow profile of this business over the last year, and many improvements have happened. Having said that, the cash flow profile remains poor. While we are in discussions with government to fix this issue, we have decided in the meanwhile not to accept any new programs under the government scheme. We will keep our commitments. Let me reiterate, we will keep our commitments because we do want to be a good partner and a reliable partner. And we will complete ongoing programs, albeit with stepped up diligence on collection. In parallel, we're going to ramp up our B2B and B2C business streams here. And these two streams will be the focus of this business going forward. I want to close by emphasizing that we have taken resolute steps to further develop our business, and we're confident these actions will continue to boost our OCF growth and ROE in the medium term, while ensuring the institution emerges even more resilient from this tragic period for humankind. With this, thank you for the time, and happy to open up with questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Sudhir Kuntupalli from Motilal Oswal Financial Services. Please go ahead.
Thanks, Raj, for that comprehensive business. Your commentary suggests that so far the headcount layoffs have not been as pronounced like we would have feared earlier, despite some of the sectors like retail being heavily impacted, and as you pointed out, despite the sharp increase in systemic unemployment. Parallelly, some of the retail companies seem to suggest that absenteeism and absconding rate in the frontline store professionals has been as high as 70% or so. And we understand from a legal standpoint, associates cannot be retrenched unless they're present and the full and final settlement is done. So 2 questions on this front. Are we seeing this trend of absenteeism and absconding in our portfolio of associates also? And secondly, while retrenchment should not have started yet on a massive scale, do you see the possibility of this happening, let us say 2 to 3 months down the line once this dust settles down and associates are back?
Sure. Let me launch it, then I'll ask Loic to also jump in. Look, I think that we did initially see high absconding rates. I think we've been, given our sourcing capability, we are very quickly able to backfill a lot of this. And therefore, at some of our larger retail clients, we actually had more people staffed, more people marking attendance in April than in March. And so I think we've not seen that. I think we're keeping a very close eye on this. So we're also just ramping up our sourcing capability right now to make sure we can backfill faster. At this point, we're very confident that we have more than enough supply for all the demand that we are seeing. And we hope that as migration, one of the things that could really impact this is if there is a solid migrant return program that the government is sponsoring, and we are in talks with various parts of government to say how do we get people back to work faster, how do we get people enlisted if they're interested in coming back. I think that could help, and let's hope that some help of that sort does emerge.
Just to add, Arjun Guru here, our exposure to retail has been about 21%, and the kind of brands that we work are, as Suraj alluded in his speech, it's really a great association that we had with our customers and the kind of longevity. So, as you rightly said, Sudhir, till the lockdown period, absolutely there are no major decisions that are being taken. So, both our customers were very understanding in terms of between April and up to the lockdown stage. Having said that, what could happen in future? There are some level of discussion. Also, the kind of ability that our people carry. So, those these are frontliners. They are key to this respective business, and the kind of knowledge that they carry, replacing them is just not an easy one. So, considering the criticality as and when the brand opens up, getting them back quickly will also be a challenge, and hence brands are mindful about working with us. So we're not seeing the major cut that has happened. So in overall, if I were to look at, it could be anywhere between 5 to 6% that can come in coming weeks.
Sure, sir. Thanks. And how are the trends when it comes to the markups in general staffing? Since clients are bearing, let us say, the bench cost of associates, are they trying to sort of pressurize vendors to take any material cuts in markups?
Lohit, you want to take that?
Yeah, good afternoon. I hope I'm audible.
Yes.
Yeah, hi, Sudhir. So that's a good question, Sudhir. I think in the spirit of partnership, there have been certain set of customers from some industries who come back and asked us whether we can take a small pricing cut during the lockdown period of, say, 55 to 60 days. We have had those negotiations with a few set of clients, and the reduction is not material in nature when you look at the entire portfolio, but it is meaningful to strengthen our relationship with those customers during this period. But to further elaborate a bit on this one, this is time bound. So this has a clear sunset clause. The renegotiation has been made in such a fashion that it automatically ends after 60 days or in some cases after 90 days. Second, being our size of portfolio and the cross-sale initiative that Suraj mentioned, we've also used this opportunity to have other lines of services appended to the same client. Third, as you are aware in this industry, while we have a great portfolio of customers, marquee names where we have exclusivity also on some of the contracts, in some customer contracts we have a shared portfolio with other staffing companies. So we've used the same hedge to tell the customers to move some of the work from the smaller or not so defined companies to us. So while there's an arbitrage on some part of the portfolio, it offsets by more work from the same customer as well. And lastly, in some of our portfolio where the same customer who has had this negotiation with us because of the COVID lockdown period, we've also cut the credit period if there was any credit. So if there is a margin arbitrage discussion which has happened, it's come at the cost of reduced or no credit to the client.
Sure, Lohit. That's very helpful. One last
next question, please.
Thank you. The next question is from the line of Tarang Agarwal from Old Bridge Capital. Please go ahead.
Hello, hi. Good afternoon. I noticed in your presentation that the cross-selling has begun to pay off, and that was suggested in the opening remarks. With almost more than 50% of clients now are working with more than one vertical of Quess. Say, what was this metric? Maybe say 2 years back, if you could give out a number.
I don't have the metric top of mind on this one, and I think we started measuring it better now in a sense. I mean, just to be clear, this is 50% of general staffing customers working with more than one client. So I can't answer you specifically, but I can tell you that what we have seen is, the rebranding exercise has significantly increased client awareness that we have multiple verticals. Number one. Number two, I think our people are getting better at understanding which other verticals are related to them and which are not related to them, and so they're getting better at describing the proposition. And so for us, this is just a process of evolution, and we will keep getting better at this.
I just want to add a point here that 3 years back we did not have a work stream around this about how to cross-sell. Now we have a work stream, we have a set of targets, and we have a process and a review for this, so that's kind of taking shape. And the next point is that 2-3 years ago our business services platform itself was taking shape. So the ability to cross-sell was not as clearly defined as it is today, now that we've got 3 clear buckets of business and business leaders in each of them.
Okay, so just maybe perhaps if I look at your revenues in FY20 over FY19, there has been a revenue increase of almost 2,500 crores. Out of this, almost 300 crores is from all sec, so maybe balance 2,200 crores is from all the lines of businesses. How much of this revenue have you been able to say mine from the same set of clients due to cross-selling wins? Is that a metric that you could probably provide?
Yeah, so we would grow about almost between 15 and 18% of our revenues from our existing clients on a normative basis, and let's say on a 20%. What we'll do is actually we'll come back to you with a more specific number on an offline basis, we've got your name now down here, but that's about the number that we've seen our clients grow at and our relationship with them. We have not really tracked to precision about how much of it's coming from existing clients, but this is
it's something we'll get better at.
We will get better at as we move along. Yeah.
Thank you. Just last question. In the operating asset management business, what proportion of your revenues are contributed by industrials?
Industrial about 130 crores. About 130 crores. 130 crores of the total local. For the full year, right? On the last page on page number 22, it's about 11% of the total of the operating assets.
Okay, thank you, and all the best.
Thank you.
Thank you. The next question is from the line of Rajesh Kothari from AlfAccurate. Please go ahead.
Good afternoon, sir. And I must say, commendable performance in otherwise a challenging environment.
Rajesh, Rajesh.
Sorry?
Can't hear you. Slightly muffled.
Oh, I see. Just a minute. So I'm saying congratulations for a reasonably satisfactory performance in an otherwise challenging environment. Am I audible now?
Yes, you are. Yep, you are.
Good, great. My two questions are, first is, what kind of, when you are saying that your month of April, you have seen decline of only 5% in your total number of employees compared to February level. So should one assume that that is the worst, or you think the May can be even worse than April?
Okay. What's the second question, Rajesh?
Yeah. So why I'm asking this first question is because there might possibility that you might have entered into long-term contracts with your clients, but as your contracts comes for renewal, maybe after 2 months, 3 months, you might see the downward momentum in that. That is the first question. Second question is in terms of where do you see the maximum, what I would say, adverse impact in terms of profitability when you look at your verticals, and therefore when you look at on totality basis, since you mentioned about 60-65 crores kind of a cost savings, do you think that would be enough to mitigate that pressure on your profitability?
Understood. So let me talk about the decline first. We've had a 5% decline. We expect to see a similar decline in May, a similar decline in June, is our sense, Rajesh. And we're sort of prepared for that at this point. That's the line of sight we have. To your question on will things go down after a contract ends, that's not how it works, because even within our contracts, clients typically between 15-30 days notice, they can ramp up or ramp down requirements in most cases. So we will not see people ending a contract and then terminating, unless they want to switch to a different vendor, and we lose the contract altogether. But historically, we've been quite good at hanging on to our customers, so we're not anticipating a lot of that. Now, so that's the line of sight we have, Rajesh. And again, I don't want to pretend to have a crystal ball into the future. I remember you and I chatting on March 5 about COVID also. Sure. If only we had a crystal ball then.
Maximum impact is this 5% decline. Is it a month-on-month you are looking at in month of May or month of April?
Yeah, month on month.
Month-on-month. Okay, basically 5% further in month of May, 5% further in month of June, and from there hopefully stabilization or maybe growth coming back. That should be our time.
That's right. We'll see how it plays out, right? And we're ready for all eventualities, Rajesh. We'll take it as it comes.
Sure.
Maximum impact on profitability. I'll take. I think there's 4 areas that have been hit the hardest in terms of profitability. Okay. There's 2 businesses that came to a standstill in terms of revenue. So DigiCare and Excellus revenue dropped to 0 overnight in the lockdown.
Mm-hmm.
Okay. The way to think about that is 30 crores of revenue per month run rate came down to 0 for April. Now DigiCare is already back to about 40% run rate in May.
Okay.
So we're hoping, as the lockdown kind of opens, that will progressively go up. Excellus, well, in both places we've cut costs as hard as we can. Excellus, also we've taken the cash burn down significantly despite the fact that there's 0 revenue, and we're waiting for government announcements on when this can open up. Right. So those 2 we're carrying, but these are not stop. sudden shock sort of risks we've taken. There is then the impact on the domestic call center business and on the international call center business, which is more, it was a sudden jerk. For a few days we stopped, we didn't know what to do, but then we got it up quite quickly, and our teams worked really hard to get it up quickly. I think there we're seeing a steady increase. What we don't know right now is at what volumes will calls settle. Right? It could be that calls settle at 25% of their pre-COVID values, and that defines the new scale of the CLM business. That we have to watch and wait. I think those are the main areas, Rajesh.
Great. If I can ask one more, if I can squeeze in, when I look at your overall, business performance, and when you, look at from the cash flow perspective, because of the pressure on the few businesses, how do you see your cash flow situation in FY21 compared to FY20?
Cash flow situation.
So again, not going to look into a crystal ball. Let me give you some of the variables that you can model, Rajesh. So I think first of all, we are going to stay on the ball on collections, right? And we think that we are going after some of our long-standing accounts receivables. We're going after our government collections. And that will bring in significant amounts of cash, and we're actually executing that in a very detailed fashion right now. This includes, for example, collecting from finance. This includes making sure our excellent business gets its receivables in. This includes some of the long-standing cash. So that's a tax refund. So that is one dimension I want you to think about. The second dimension is we're actually working on cleaning up our UBR, AR processes, getting them more automated, more seamless, so we can just bring down to our shared services, improve our billing cycle, and that should help overall the AR time. Right? The third factor to think about here is that if our business does shrink, the amount of working capital we consume will be lower, and so that will come back as OCF in the system. So it should be a good OCF year.
Oh, I see. Great. Good, sir. Thank you very much. Wish you all the best. I'll come back in queue.
Thank you. The next question is from the line of Aditya Bakul. Please go ahead. Aditya, your line is in talk mode. You can go ahead, please.
I'm sorry. I hope I'm audible.
Yes, sir.
Yeah. So our total gross debt as we stand in March is about 1150 odd crores. Just wanted to understand what is our deleveraging plan over a period of the next 2 years. Do we envisage ourselves to be debt free? Its impact on our interest cost and consequently to ROE. So that's question number one. And the question number two I had was on account of goodwill. So just wanted to understand our rationale for the goodwill write-off that we did this quarter, and just thoughts on something that may come going forward.
Thanks, Aditya. Ramki here. I think one thing which we want to emphasize on our debt, right from December, which we were at about 830 crores of gross debt, it went about 1,147. And one of the main reasons for that was also because this entire pandemic situation started getting a little more severe, probably in the second half of March. And obviously, in our business, the most important capital is the human capital and making sure that we pay our employees on time. So under those circumstances, it was important for us to make sure that we have the money on time, and we don't get caught between the remote technology and the fact that we are not able to pay salaries to our employees. So under those circumstances, we had to maximize our credit lines. What is important for us also to see is though the gross debt increased by about 355, the net debt increased only by about 42 crores. Now moving forward, what's the directive? Obviously, like Suraj said, our focus is on collections and cash. So that being the case, we'll get back to our original path of coming back to reducing our debts, because our working capital consumption also will start going down. So that's the answer on the debt. Quickly coming on to goodwill, obviously you'll appreciate the fact that this is a one-time non-cash charge. And just to kind of give you a background on how we approach the whole thing, in the month of April, as we were closing, obviously, that's the time, the COVID was kind of, we were not able to quantify how severe and significant this was. but we knew for the fact that this is not normal circumstances for sure. So under those circumstances, it was important for us to take a very prudent and conservative step towards bringing down our projections for the current year in terms of our valuations, and thereby, making sure that the projections are a lot more, realistic. Moving forward, again, our projections from next year onwards are back to our normal projections in terms of our growth path. The other important thing is also to understand that the assumptions used, be it in terms of growth, be it in terms of discount factor, be it in terms of risk pattern, is uniform across all CTOs. We have not cherry-picked any of these for any of the particular CTOs. This is extremely important for us to understand because after this exercise, we are still left with sufficient headroom in all the CTOs. This is from an overall thought process perspective. From a process perspective, we did use one of the big fours to kind of advise us. The valuation was done by an independent external valuer, and this was also went through the audit team of Deloitte and their valuation teams. And also there was a stress test which was done on the numbers, which is part of the valuation exercise. And after all that, we agreed that this is the kind of impairment that the books should be taken. So with that, we took an impairment of about 506 crores and moved on with things with also intangible correspondingly about 134 crores. And just to kind of let you know that this will be a one-off and we wouldn't be required to do anything further on goodwill or intangible.
Perfect, Ramki. That is loud and clear and very encouraging to note. Just one last comment from my end. The point is that when we spoke last in March, what I understood was that a deleveraging, that is reducing our sort of interest or increasing our interest cover over a period of time would be sort of essential for us to translate into a 20% ROE company. I understand that we are in a difficult situation right now, but over a period of time, that should be one of the areas that we would be focusing on.
Without a doubt, Aditya, definitely that's the case. And even if you look at the numbers, from about 40, 45 crores, then moved on to about 40 crores. And this quarter also, we were able to reduce it quite well until about this last, 15 days. That alone resulted in about 3 odd crores of an additional interest. But if you look at it, definitely, we will focus on this item even more and ensure that the interest cost is kept to the minimum ROE interest.
Perfect, sir. Thank you. Thank you so much. Operator, we could move to the next question, please.
Thank you. The next question is from the line of Abhijit Akela from IIFL Securities. Please go ahead.
Yeah. Good afternoon, gentlemen. Thanks a lot for taking my questions. I just had a couple regarding the cost containment initiatives that you spoke about. And the first was about the indirect cost structure, in which you mentioned that you're taking initiatives to cut the indirect cost. It's running at about 65 crores a month by about 20%. And then I think Suraj also mentioned that you aim to reduce this by at least 60 crores per year. So I was just sort of trying to reconcile those two numbers with each other. When you say 60 crores, is it during the course of fiscal 21 itself, and then will it be a larger run rate going forward into fiscal 22? How exactly are you looking at that?
Well, that's a good question, Abhijit, and thanks for asking it. No, I think what we've recognized in April versus, say, February was a 20% decrease. Okay, so that number, you can do the math, it's about 12-13 crore off EBITDA savings in February. When I said 60 crores, obviously some of the savings we've got at this point are somewhat one-time in nature. Like taking, travel's gone to zero, our power costs have gone down quite dramatically in these buildings. So we're in the process of figuring out which ones are going to be sustainable, which ones are not. So when I said 60, that's a little bit of our first estimate of what the through the year number could look like. Also keeping in mind the fact that last year, indirect, if you compare year on year, last year indirect costs went up through the year in FY20. So the average will be less than the February cost. So I'm just giving you a little bit of an average-ish number. This is what we should realize in the year on year when you compare. At least.
Understood. That's helpful. Thank you. And the second question I just had was, there's a comment on, I think, slide 13 of your presentation about a sliding scale that will help you variabilize your cost structure. So just trying to understand that a little bit in more detail, if you could please elaborate on that. Thank you.
No, sure. I mean, this is one of Ajit's innovations, and I think it's a brilliant one. Look, I think what we've tried to do is challenge ourselves to say, at this point, let's say our business is X% down in revenues from where it was in February. So what if that X falls by 10% more? What if it falls by 20% more? What if it falls by 30% more? The intellectual exercise we're going through is to say, how do we make sure that, it's difficult to maintain the same EBITDA margin as your business falls, but how do we make sure that we retain a EBITDA margin and keep it as constant as possible? What does that mean in terms of buildings you would give up, in terms of steps you'd have to take on resizing our employee base and so on and so forth? It's just contingencies for contingencies for contingencies, Aditya. For Abhijit, just to make sure that we've kind of thought through the future properly.
Great. Understood. Thanks a lot, and wish you all the best.
Thank you. Same to you.
Thank you. The next question is from the line of Jignesh Kamani from GMO. Please go ahead.
Hi. Thanks for the opportunity. Few of the retail later mentioned in the recent remark that just to comply with social distancing, they need to reduce their headcount by almost 25% in the front line. So any color based on your interaction with your client, if they want to maintain social distancing, how much headcount cut they might need to take, even though business is as usual?
When you said they, who do you refer to?
So when I interact with some of the national retailer who has, you can say, 300, you can say EBO and maybe 100 plus, you can say department store and everything, they mentioned that just to maintain the social distancing norm as per the regulation, their headcount has to be 25% lower in the front line.
In store. I see what you're saying.
Okay. Our exposure to retail in that space, where there is high density, not really high. So, for example, if I were to give you an example, in such a case, wherever we have, say, more than 8-10 people working under a roof, the plan is to do alternates or based on number of shifts. Yeah, so there are a lot of intensified plan which is being drawn between us and customers. So there are roasting that will happen for associates in terms of their reporting timing and etc. So that is what is happening in high density. But otherwise, most of the retail units, the density would be low where we are deployed our resources. So really we are not seeing major change in that.
The only one thing I would add is obviously all retail is not the same. So, where we've had some exposure to, let's say, travel retail companies, there we have seen people been asked to kind of demobilize and so on and so forth. The number we're giving you is kind of a net number across different industries, different customers, right? So there are clearly some who are more impacted than others.
Understood.
Yeah.
Thanks.
Thank you.
Thank you. The next question is from the line of Sandesh Shetty from Phillip Capital. Please go ahead.
Am I audible?
Yep.
Yeah. Good evening, everyone. My question to you is, with regards to goodwill impairment, if you can give us the breakup of goodwill impairment across companies wherein this 6.6 billion falls in.
Yeah, the goodwill impairment of 506 crores pertains to the following CGUs. In the IFM business, it was 312 crores. In the MFX business, it was 52 crores. In Allsec, it was 51. In Vedang, it was 27 crores. And in Greenpeace, about 25 crores. And in Trimax, about 40 crores. So this is on the goodwill. And on the intangible, which is the other section of the impairment, which is about 134 crores. The IFM was 76 crores. Allsec was 48, and Vedang was 10 crores. So that's the split.
And so one more question. When we say IFM, is it mainly to the Manipal vertical? Erstwhile Manipal?
Yes.
And sir, one more question, if I may squeeze in. With regards to your tax, it's a bookkeeping question. Like this year, this quarter, if you see, in current tax, it is positive. If you can throw some light on it, like what's the implication and what is the tax implication of this write-off also?
Yeah, so I think tax, if you look at it for the current quarter, I think there are 2 or 3 parts to it. I think we had also alluded to this in our December call. We had told about this in the March 5th investor conference that we are moving to the new tax regime. Obviously, if you're moving to the new tax regime, which is a lower tax regime, which still allows us to continue to take the 80JJAA deduction for employability, there is a one-time write-off which needs to be taken in terms of accumulated MAT credit and also the incremental deferred tax for the change in tax rates. That itself is about 140 odd crores. Having said that, the entire 140 crores did not take a hit in the tax line because there is also a corresponding reversal of deferred tax liability for the goodwill which was written off. And that itself for the goodwill and the intangibles put together is about 105 crores. So what you see as the impact in the financials is only the differential between 140 and 105 and nothing else. Other than that, the impact on tax pertaining to at a Quess level is zero tax, but it could be tax pertaining to some of the other entities which were still not on the zero tax regime or on some of the overseas entities like Comtel and so on. So it's a very marginal tax element which is other than these adjustments.
Okay, sir, correct my understanding if it's correct, like because of the goodwill impairment and also because of the lower tax rate, the net current tax for this quarter is positive, if I'm not wrong.
Correct. Okay.
Yeah, thank you. Thank you, sir. That was really helpful. Thank you.
Thank you.
Thank you. The next question is from the line of Deepak Poddar from Sapphire Capital. Please go ahead.
Hello. Yeah, thank you very much, sir, for the opportunity. I just wanted to understand when you are speaking about 20% ROE targets, what sort of timeline you are looking at?
So we had said FY23 on March 5, Deepak. At this point, we don't have any information to either push it out or bring it forward. So we'll keep that target. And, like I said, we're not looking into the crystal ball right now. We're just working very hard to do all the right things and to do everything we can.
Fair enough. That's all right.
Thank you.
Thank you. The next question is from the line of Nagaraj Chandrasekhar from Laburnum Capital. Please go ahead.
Hi, thank you for taking my question. I had a follow-up on an earlier question regarding cross-sell driving a large part of sales for us. You said that 15 to 18% of incremental sales are from existing clients. Is that in the existing verticals or is that mostly through cross-sell? Because when you go and sell general staffing services to a facilities management customer or vice versa, or a customer service customer, shouldn't the buyers be in different parts of the customer organization? Why then would being able to cross-sell be possible or easy anyway? Why should it help?
So that's a good question. I think what happens in an actual situation is that when you do cross-selling, it's usually to a large corporation on the other side. So it's to a big enterprise. Large enterprises have centralized procurement teams, and procurement teams work with multiple functions inside an enterprise. So when we tend to build a long-term relationship with an enterprise, then we get to know the internals of the organization, what are the dynamics of sales that work there, and where is their shoe pinch most. And that's how we're able to construct a sales program around the cross-selling.
Understood. Just a couple of bookkeeping questions. Just on on this, what percentage of our revenues would be, from sort of customers where we have these what you would describe deeper relationships, where we are able to continually cross-sell other arms to every year?
No, what I would say, I mean what I would say is the number I put out earlier was, if you look at our top, let's say our top 30 clients, right? 21 of them work with more than one vertical. That's about 3,500 crores, let's say. So you're talking about maybe 30% of our client base, some 30% of our revenue base, some 30% of our clients. Look, I'll be honest with you, we're getting better at measuring this, and we will get better. We're also going through a little bit of an IT system upgrade, which will help us get even better at measuring some of the numbers you're asking us. These are good numbers to ask, and these are numbers we will be able to give you. Just at this point, we don't have the comprehensive answers. What we can see is, what we're trying to do is pick groups of customers now where we feel cross-sell should go up, either because we think these are customers that are ripe for cross-sell, or we think that these are customers where our penetration is low, and that's what our top 75 named accounts initiative is for. We've kind of, in those accounts, for the first time, we kind of do a comprehensive account mapping, understanding the buying centers, understanding who has relationships where, and driving very systematic cross-sell in those accounts. So it's a little bit of a learning to walk before we can run. I think it's getting better is all I can say, and we'll have better numbers for you in a few quarters, much more systematic in a few quarters.
Got it. And just on our legacy acquisition amounts payable, how much would be left for us to pay in terms of agreed liabilities left to take our stakes up in past acquisitions over time?
So we have only one big stub that is remaining, which is the Connect Business Solutions one. We own 70% and there's a 30% stake held by the Tatas. It will come up sometime next year. November 21. And so there's an agreed pricing formula. So, which we will disclose as per the numbers that emerge closer to the date. But we are sufficiently financed and within our means to fund it without any further debt to complete the transaction.
Got it. And just finally, on our receivables, could you give some sort of color over how much would be those to the government arms, how much would be over 3 or 6 or 12 months overdue, and what sort of provisions we would have made on those thus far? Thank you.
So can we take that offline, please? Because there's a bit of detail about how much is by business in each vertical, etc. So I'd be happy to discuss this with you offline. Also, our moderators increasingly sending us messages that we've overshot the time limit. So sorry about having to cut this off, but I want to thank you all for a very energizing session and for the many questions that you raised. As you've seen by now, we have a number of initiatives at Quess, many of which are long-term in nature and with serious impact on shareholder returns. As management, we are focused on realizing the goal of 20% ROE with 20% OCF growth in the medium term, and we intend to do what it takes to achieve it. Thank you for your support and look forward to interacting with all of you in the future. Thank you very much.
Thank you. On behalf of Axis Capital, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.